All right, hello everybody. Welcome in. We're here on our 23rd weekly webinar. This is the first webinar of 2024. I'm hoping you guys have some questions. I say this every time, so if there are some questions while I do the intro here, it'd be helpful if you sent me a private message or you just typed in the chat any questions you have so I can start putting together some responses to those. And outside of that, what I wanted to look at today was, again, analyzing how we might trade given certain things that we're seeing happen in the market. Remember, as discretionary traders here, we don't know what's going to happen next. All we can do is look at where price is going in relation to certain levels we have and basically trade around them, right? I mean, at the end of the day, you don't have to be right about the direction of the market in the larger scale or the higher time frames. You just have to be right on your entry. And if you pick the right side, you end up getting into a really good trade. So that means there might be a bullish bias in the market, but on the short time frames, if the bulls are not able to get above certain levels and the bears pull the price down below certain levels, and you've got some clues on your shorter time frames, which again, we've got plenty of webinars telling you how to trade the 512, the 3-minute chart. Then you can play in that direction and potentially capture a beautiful trade. So what I want to look at is what happened here today, and consider some things that you might have done as the market started to show some of its clues, right? So again, we have 22 other webinars that were done before this. Some have less information than others, but what I would say is, if you are still having questions as to how you would find trade setups in a bearish market or a bullish market using the 512, using your 3-minute chart, I'm not going to spend the time to talk about it because I've already spent a lot of time talking about how you would find specific entries on this chart. And now I want to talk about trying to find direction. So if you remember this morning, I sent out the report, and the big thing in the report this morning was the previous daily low, right? So for the bearish case, we really wanted to see them push down below the previous daily low. We talked about seeing some counter bullish signals from that level. And if the market was to hold the previous daily low and actually start to trend in that direction, that might have been a clue that the bulls were going to lead to some larger push. But what ended up happening was, right out of the open here, here's the vertical line is where the market opened this morning, and that we were already below the previous daily low. Okay, so that should be a clue at the beginning that maybe the bearish perspective is the side that we want to be on. Now, you guys know I say this nearly every time we do a broadcast, that just because we hold below a level or we get a signal or whatever it is, doesn't mean it's going to get follow through. And that's what makes trading so hard. If everybody knew the direction and knew the perfect entries, I guess everybody would just sit at home and not do anything with their lives, at least to make money. But that's not the case. We don't know what's going to happen next, and curveballs are thrown all the time in the market purposely to take your money. So again, you have to keep in mind the caveat to everything that I teach and everything any other trading educator teaches you is the market is tricky, and it might give you a clue for one thing, not do it, and then end up doing it after it fakes you out. So there's a lot of uncertainty when you're trading, and that's what makes it so hard. So what I've learned over the years is to find some type of really nice setup off a really nice level and just have faith that the setup and the level that I'm relying on has some type of edge to it. And I think we've seen, even if you've only been here for a day or two, there is a lot of edge to the levels that we work with. So first level that we were working with this morning that we wanted to see hold to the downside was the previous daily low. And this is another thing I also want to mention. When I say something like, if price stays above the previous daily low, we have a nice bullish signal on these two important time frames. Well, what does that mean from a trading perspective? Well, if it doesn't hold from the previous daily low, we're not going to have that bullish signal, i.e., or in other words, that probably means we're going to go lower. Now, there's no guarantees in trading. Again, I'm not going to reiterate what I just said, but that should give us a clue that if the bulls can't hold from an area where we have a potential bullish signal, then and it breaks, that we need to consider the counter, right? I said this morning as well. Let's see. I'm trying to find. I thought I had something. Yeah, so ideally for the bears, they hold from our roadmap levels, break the previous daily low. The notable trouble for the bears are around our task zones. So what would that mean if you were to read notable trouble around our task zones? And where are our task zones? Let me pull up the 30-minute here just to give us a little bit of a broader perspective on things. When we were selling off this morning from the previous daily low, what was our first task zone for the bears to get through? It was this little 2-point pocket, 3-point pocket, right around our scaffolding level at 46. So we've known for multiple days now, if the market ends up coming down and gets through this first task zone, which by the way, yesterday was where I got short and where in the overnight session coming into today, we held nearly to the tick here and continued lower. We've had these task zones on the chart. So you already should have known that right around 45 to 46 here, that could be a trouble spot for the bears if the market starts to come down into it from the top end. So what does that mean from a trading perspective? Do you want to just wait for the market to get here and click sell? You know, like what would you be thinking if you knew there was a level in the market that we wanted to see the bears get through to continue on in the bearish direction? When we come into that level, what are some trading ideas? One of them is to play the counter. And the counter would be maybe the bears are going to have trouble at this level. And so maybe this might be an area to actually buy and place a counter trend trade to see if you're going to capture that bounce or that rotation. Does it work every time that we come into a task zone? No. But just here in the last day, and I'm not cherry picking today. I've just picked today because I think there was just, a decent stuff to talk about. But the high of the day before the market opened in the overnight was the task zone above, and the low of the day yesterday today, right up until kind of the last hour of the market, was our next task zone. So when I give you these levels or these more important task zone areas, even the roadmap levels, but more importantly these larger task zones, these are areas where we expect there to be a rotation or a reversal, or if in the worst case scenario, maybe a small bounce, some type of reaction before they keep going. So that means, this is a potential trade opportunity. Again, it's not going to work every time. There's no trade setup that you're just going to come in and make money off of every single time you try it. I don't think. I mean, maybe someone's got some super secret thing going on, but for all intents and purposes, nothing's going to work every time. You have to accept that sometimes you're just going to put trades and they're not going to work. And that's when the risk management comes in. We spent a lot of time talking about risk management in previous webinars. So plenty of material to review there. But you have to get comfortable as a trader with losing trades. You just want to make sure that when you are putting a trade on, that there is some type of logic, right? We don't want to just blindly buy or sell. That might work for somebody. That might work for you. You might just say, hey, look, maybe on the 512, hey, look, we're starting to break lower. I'm just going to start hit and sell and, have no stop loss and just renegade it. And some people might make that work. But in the long run, for me, I needed to have some type of method, something consistent that over time I could track. And just blindly buying and selling based on how you feel is probably not going to provide that. You might have some success at the beginning. And hey, maybe there are some people out there that trade like that and make it work. But not having some type of system some type of basic framework for what you're going to do, in my opinion, is a recipe for failure. So again, we have these levels to work with, right? We have the major trend zones where we expect there to be, or major task zones where we do expect there to be major rotations, just like the one that was right over here, that we were looking at just a couple minutes ago, right? So, or maybe I'm mixing that up, but then from there, once you have the areas of interest, now you need to start thinking about, well, do I just blindly enter off that level? Do I wait for additional confirmation? Things like that. So there's a great example here this morning, and it happened to be one of those textbook setups that I've taught in the past. When we see the market get away from the 200, come back up, test into it, you get some divergence. In my case, that's what I like to look for. And there you go. There's a trade setup. Now, just because the market's coming into the 200 doesn't mean it's just a trade opportunity. I mean, maybe you could look at it like that. But if you put context on top of it, you add an additional dimension to it, now you're giving yourself, in my opinion, a little bit more edge for your trade. So let's look at this this first thing I wanted to talk about, and that is this opportunity off the 200. And so let's just talk about it. We talked a couple minutes ago about wanting to see this level, the previous daily low, hold for a potential bullish rotation. It didn't hold coming into the open, and then we started to hold below it for quite a while. So there actually was, your first opportunity was to get short off the 200 because of that fact, okay? It would have been a little bit premature maybe. It would have been an aggressive thing to try. Just because you're aggressive doesn't mean you're not going to be successful. But what I want to talk about here is if you are a little bit, you're a little nervous to try something because you don't have any confirmation, that's when patience comes in. And if you were patient this morning, you got a really good opportunity when the market bounced out, right? We started ducking through our expected areas of support and then bounced out, probably faking some bulls out here, expecting that to be a typical peak below and bounce. And then it failed right off the VWAP. There was even some decent divergence in that area, at least on the 512. I don't know about the 3-minute or anything like that. But I'm not even talking about a trade here. I'm just saying, noticing from the perspective of the levels that we pay attention to, that, okay, we're holding below previous daily low to begin with. I mean, we're in a bearish orientation in terms of our moving averages. Again, another topic that's in one of the webinars. And then the bulls attempt to break out and get swatted right back off the back end of the VWAP. Okay, another key thing that we talk about with the strategy that I use. Now, you could have jumped in aggressively here when the market started to break down below. But if you were patient, and sometimes being patient means you miss out, sometimes being patient means you nailed probably one of the best trades of the day. Again, that's the trouble with trading. So starts to come out. Again, you could have been aggressive and just shorted. But this right here, when you start to layer in some type of bias, the fact that we couldn't get through VWAP, we couldn't get through the previous daily low, and now we're getting a continuation to the downside, and we end up breaking through the morning low at some point there. Okay? Well, now when the market's bouncing back up to test into the 200, that's where, if you're patient, you can now sit and wait and see, are we going to test into it and maybe even get some type of divergence in that area? And that would be a good hypothesis for a trade, right? We're holding below the level we want to see hold for the bearish side. We even tag into something and fail off of it, a very critical area in the chart for a bullish bearish bias. And then we break the low of the morning session. and come back to test the back end of one of our textbook moving averages for trade setups, right? If you wanted to add an additional layer of confirmation as to why this area would have been good for a short, I'm sure you're looking to the left-hand side here, noticing you also had a prominent little swing here, at least on the very short time frames, right here where the 200 is sitting. So as the market's advancing back up into that area, you have a great hypothesis for a trade. Doesn't mean it's going to work, but this is a great area to try. If you want to get short and you're noticing all the bearish things happening, well, outside of everything on the chart here, where would we want to really pinpoint? Probably somewhere around the 200. Again, going back to the strategy, probably somewhere around one of our roadmap levels, and then probably right back to the line in the sand and the VWAP. Like, these would be little pockets that would make sense for rotations, right? So even if you didn't get short this morning just because you wanted to blindly short, or you just noticed maybe a failure off VWAP, all these additional pieces of information are now giving you a good hypothesis for your setup, right? So we ended up coming across, I think the low right there was just a tick from the 200 at that point. There's your divergence off the high, at least on the 512, right? And then there was your opportunity to get short. Now, whether or not the market actually goes 10, 20, 30, 40, 50 points, or it only goes pullbacks and holds the FMA, or only comes down in front of our roadmap level, that is not really, it's neither here nor there. The idea is you have some type of bias based on what levels are holding in the market. You have additional pieces of information that are confirming that bias, and then you're finding an area in the chart that makes sense. Like, I don't want to just get short right here, right? Or just right over here, or just in the middle up here. I want to pinpoint it down to the levels in the market that typically do hold when we get tests. So that would have been, in my opinion, a really, really intelligent trade to take this morning. Now, I wasn't really at the computer today, so I didn't trade. But this right here, with your divergence right off the 200, going in the direction of what looks to be the beginning of some type of downtrend, now lines you up for a great trade. Like I said, doesn't mean that you're guaranteed a 10, 20 point push, but it does give you, it limits the area in the chart for your entry, and anything that happens after should not be an issue. If it goes 3 points and that's all you make, great. If it goes 30 points, great. The main point is that you had some type of bias and you executed based on that bias intelligently. Okay, so in this case, if you shorted the 200, there wasn't even a single tick of heat, right? And then I would hope that by this point now, 6-7 months into the roadmap service with all the webinars, you would understand if you do get short, there's probably going to be trouble at the FMA. There's probably going to be trouble at the next relevant roadmap level, and so on. And it just so happened that down below us, what do we have down here? Let's bring this up. The next expected support, once we got through that first roadmap level I just was highlighting over, we had not only the scaffolding, but this little pocket from about 44 to 47 that we expected to be a very, very strong area of support. So that is 47, 46. So that's what you see here, 47, 46. So if you got short up here, you should have understood that there was possibility it was just going to be a short-term thing and it was going to bounce higher. There was a possibility they were only going to come right into our roadmap level. And then the next area that would make sense, again, not just randomly right here or randomly right there, but right here, our pocket, 44, or what did I say? 44 to 46. Somewhere right in here. Oh. Somewhere right in there would then be not here, not there. Somewhere right in here is where I would expect to see the market go ahead and find the larger support. I feel like there might be some questions. Okay, cool, sweet. So yeah, I'll adjust that in a second. So, in this case, going into the trade, let's say you didn't know what's going to happen next. You knew that you had at least a 5-6 point push to the roadmap level. It was 6 points, but again, I would rather take some profit in front of it rather than waiting for price to come into it, because we do see a lot of times the market come 1 or 2 ticks away, and that's where the rotation happens, right? So you knew you had at least 5 points down. If the bulls didn't just hold the FMA and bounce out again. So you knew you had 5 down. You knew you had another, remember, you're shorting around 57. You had another 10 points down to the first pocket. Remember that. Should have it on the 512, guys. I apologize. But that pocket right there, 44.5 to 47-ish, right? So that would have been maybe your ultimate target, because that was the level we established as being probably the most probable area for a bounce, at least in this local section. And so there you have it, guys. I mean, we came right in. Now, this is why I take profit in front of the level, right? So it ended up bouncing 46.5. Our scaffolding was 46. I would have been out at 47 and would have nailed the low. And you guys have seen some of the other trades I've shown in the live room. I mean, sometimes I'm getting in on a rotation and literally getting out right at the beginning of the larger bounce in terms of a short. And that, again, it's just from experience. It's seeing the stuff happen over and over again. It doesn't mean I don't put losing trades on. It just means that I understand the larger rotational areas in the market and understand that I should be taking profit in front of them, okay? So that's really the main thing I wanted to talk about today, is you don't necessarily just have to short a level or buy a level, but when you start to get confirmation of the direction, that's when you want to start thinking about finding those setups. Now, you guys know yesterday I didn't quite wait for confirmation on my short back here. And that was, again, mainly because I saw the 3-minute. I saw we were testing into the back end of the 200 in this huge downtrend. And I thought it was worth 2 points of risk to see if we could get a push, again, from 87 all the way to 77 for a nice 10-point trade. And again, take some along the way, take some of those contracts off. Right? So in this case, we had sold off let's see, about, let's say, 50 points. And interestingly enough, right off of the level I told you guys made the most sense for the pullback. Actually, I take that back. I'm mixing it up with the level we failed from. Am I? No. Okay. Yeah. So we came right up into it in the overnight. This was, again, in the middle of the night, right into it. And then we started to fail out. We ended up holding down right around the 200 at that time. And I just thought it was a worthwhile thing to try. So in this case, maybe I didn't have additional confirmation for the bearish side because I wasn't waiting for this to come down and break the low of the overnight session and come down lower. This was more so just recognizing a very heavy downtrend, recognizing that we were popping back into the 200, kind of like the trade setup we were looking at just a couple minutes ago, and thought it was a worthwhile opportunity in terms of risk of reward. I knew I had 10 points to the downside. Even getting out in front of the level, I was up 10 points, and I was willing to give it a shot. Okay, I had my 3-minute bearish signal up top, and there you have it. So what I want to do is look at what helps me is knowing market structure before starting the day. So Kevin, when you say market structure, what do you mean by that? Because I actually talked to someone the other day who talked about market structure and meant something completely different. So I just want to make sure we're on the same page with that. what is like the trend market structure? Well, how are you determining that? Are you talking about seeing where we are in relation to previous daily levels, scaffolding? I mean, are you just basically saying that the things that I'm teaching? Oh, you're looking for channels. Okay. So I think this is actually a good opportunity to just mention that it really doesn't matter what you're using. I mean, assuming that, give me 1 second, I just got a text I have to respond to. It doesn't matter what style or what type of, give me 1 second, sorry. It doesn't matter if you're using trend channels like Kevin's using, or you're just determining direction based on what levels are holding, or you have some type of signals that you're relying on. The most important part is going to be what works for you and whether or not there's an edge to that system. And then if there's some edge to it, then it just comes down to risk management. And risk management is not only your money, but managing your emotions, managing that emotional capital that you have at the beginning of the day. Because we all know when we start to lose some trades and our psychology goes out the door, typically that's when we end up giving even more away and, you know, go on tilt is what they say. So it doesn't matter how you're determining your setups. Again, assuming there's some edge to what you're using. There's edge in moving averages. There's some edge in, again, looking at where we are in relation to the previous day. If you're an intraday trader, you know, there's edge in trading around VWAP. You know, more often than not, VWAP is going to be kind of that line in the sand, I guess you could say, for a bullish or a bearish bias. There are people that trade with just the VWAP on the chart, and they're typically trading either reversions to that mean, or, you know, they're building a bias based on which side is holding. So it doesn't really matter. But the most important part is going to be where your entries are and whether or not your entries have some type of edge. In my opinion, just dealing with our moving averages, just dealing with our levels, that's really all I need. I know there's edge to them because I see rotations off these levels basically day in, day out. So it doesn't necessarily matter what you think market structure is or how you're determining bias. Again, assuming you have some type of system that has a little bit of edge to it. I mean, I'm not just saying you come up with anything and it's going to work. Yeah, so there you go. I mean, Kevin's saying if the market's below VWAP and the 200, well, what do you know? I mean, this is that webinar we talked about this concept, you know, a couple of months ago. When you have the fast moving average falling below the slower moving average, and even more importantly, once that 200 gets through the even slower moving average, the VWAP, now you're in the conditions for a market where you want to be selling any type of bounce. And again, that doesn't mean it's going to work. Sometimes you're going to short the bounce and it's going to be the beginning of the break in the trend and it's going to go higher. But again, risk management is the name of the game in all of this. So, you know, in this case, whenever the 200 gets down below VWAP, you now are looking for trades in that direction. That might be all you need to become a successful trader. That's the only system you would need. Every time we get a crossover, and it could be just the slow and the fast, we don't even need to consider VWAP. And this is the strategy I taught is once this crossover happens, all you do is literally sell. And at some point, yeah, you're going to be wrong, or some points you're going to sell at the wrong level, and it's going to go further and then hold and continue going. But But that's it. And then once you get a crossover for the bullish side, like right here, well, now you just start buying pullbacks, right? So in a bearish orientation, you'd be selling the bounces. In the bullish orientation, you'd be buying the pullbacks. Does that mean every pullback's going to make money? No. Sometimes this is going to happen. It's going to go right on through. That might be the beginning of the change in trend. In this case, I believe it was. But that's really all you need. You need some type of consistent thing to rely on that has some type of edge, and then you need to be managing risk whenever you're wrong. And sometimes you could be wrong 50% of the time or more and still make money. Yeah, so risk management is like the holy grail of all of it. You know, you could just take the levels we have, understanding that they work more often than not. Maybe it's only 55% of the time. And then every time you win, you're winning, say, 3 times what you're losing. Technically, you should be making money in the long run. Now, that's the tough part, is that the market's always changing. Your psychology and your execution of your strategy is always changing. And that's, again, it's one of the hardest things to do, is to be a consistently profitable trader. And I mentioned this in the past, that even guys, like some of the big names in trading have had difficult months and even difficult years. So, it's a very difficult thing to turn into consistent daily income, which is probably a horrible thing to hear. But it's not impossible. I think that's the main thing that a lot of us are trying to point out, is it's not impossible to have some consistent profits. It just takes a lot of work to be aware of your emotions, know when to step away, executing your strategy correctly. Some days you're going to do everything right and you're going to lose money. Other days you're going to do everything wrong and you're going to make money. Okay, so it becomes a very difficult endeavor. And ever since I started this educational business, I guess you could call it, I've been really strong on the fact that this isn't easy. Like, there's a lot of educational systems or groups out there, or trading businesses out there, and they're trying to sell you on, come to my system, come learn my system, and you'll start making money, a couple $100 a day, or a couple $100 a week, or $1,000 a day, or whatever it happens to be. Come make 20 grand a month. Spend a couple weeks with me, learn the system, and that's it. And that's just, you're going to learn, especially if you're newer, that's just not the case, right? So anyway, I think the main gist of this webinar, the first webinar of the year, is you don't necessarily always have to be just kind of blindly doing something. You can be waiting for some type of confirmation of the direction. Okay, vice versa today. Let's say the market did exactly what it did here, but then popped right up through VWAP and started coming up higher into here. Well, that would have been a total different scenario. And the clue would have been that we were getting back above VWAP. We were holding the previous daily low. It was a peak below, but for all intents and purposes, we held the low of the day before. We're getting back through VWAP. Well, now maybe I want to think about finding some longs, but that's not what happened, right? We push lower. Here's your crossover. We're holding our levels, and then here's your test of the 200. My favorite setup is gotta be the 3-minute showing potential divergence off a level, and we went through this a couple webinars ago about that setup, and that's basically my favorite setup. Is, for instance, testing into VWAP with a potential 3-minute bearish signal, and then something like this happens where we kind of start to pull back from it, or something like that. So today, I'm not sure if the 3-minute was set up there at 7:05. Let me look on my chart. And actually, there's a second thing that I want to point out about this morning, and it reminds me of something I wanted to mention, and that is, let me see if I can squeeze this in here. Squeeze that there. I will get to all those comments and questions in just a second here. But there was something else, again, with the 3-minute here this morning, that if I was here, I probably would have traded it. So that was right around the market open here. Right around 641. We had the first setup for what I like. And that is, well, first of all, the first test right out of the open here, when the market was right here around the previous daily low, there was already some 3-minute clues here for the bearish divergence. See how we pushed down to a lower low or lower high on the price, but this pushed to a higher high. That was something I definitely noticed there in that first minute or two. But something else that I noticed is this. And it's kind of funny because, again, we're in a bearish market. We're pushing lower. So who the hell's going to want to buy this if we're selling off really heavy? We're breaking through our line in the sand for that bullish bearish setup that we were looking at. Who's going to want to buy this? But I literally saw this and was like, ooh, that would have been great. We were testing into an expected support. Again, it wasn't quite as deep as the bigger, pretty sure. Yeah, it was big. The bigger task area was down here. But this being a roadmap level was a potential support. And as we were testing it, you could see that we had that bullish potential on the 3-minute. Okay, we got it just before the market opened, and then we came down a little lower, and this came up a little higher. So there was an opportunity to be the counter guy here and actually buy that level looking for a bounce. The problem with that is there wasn't as much upside because the test of the PDL was really the main thing we were looking at. So even if you bought 61, you didn't even have a potential for 5 points. So maybe it wouldn't have been as sexy of a trade setup. But that was there. And then look what happened here. When the market came back up to test into VWAP, or actually just before it, let's go back. This is the thing I wanted to show. It's not the VWAP play. It was the play. Notice what happened here on our 512. So you had the push down right to the scaffolding. Again, there was that test here on the 3-minute with the potential bullish signal. They bounced it out and came right back to it. Still had the potential there. So by the second test right here, you could see very clearly that potential bullish rotational pattern, right? And then from there, so that might have been something that, in my opinion, would have been a great trade opportunity. Now, your expectation to the upside, again, would have been basically back to the PDL and the 200. So really, if you got in, maybe you didn't get filled at 60.5, you got filled at 61. You're really only looking for a little scalp. Given the bias, we're selling off. We're in that bearish orientation in terms of moving averages. We're down through the main level. We want it to stay below for the bearish side of things, and being a counter guy, you have to keep in mind that was probably more so likely we weren't going to be able to get through there. All right, so there was that opportunity. But then when when the market came up and tested the 200 at 47.6475, this is what looked like on the 3-minute right here. So we were pushing, we were not quite, we had this high, and then the high I'm looking at right now, which was the test of the 200 at the time, right there. Well, the 3-minute was showing very clear potential bearishness as we were testing into the 200. So that right there, in the direction of the overarching bias, because we had broken through the previous daily low in this bearish orientation of our moving averages, that right there, in my opinion, would have been a really, really good trade to try. Again, not only just because it was testing the 200, but we also had the 3-minute bearish divergence, and we were also breaking below the line in the sand, right? So that would have been a really good opportunity from the perspective of this, seeing the 3-minute showing some potential as we're testing into a very good level. So Alonzo was saying, did you say that the gist of one of the main strategies is a crossover of the moving averages in confluence with a level? And yeah, I mean, basically, the crossover, and just to kind of clarify that, the crossover doesn't have to happen at a level, but if you get the crossover and then you get the break below the level, so in this case, in the bearish orientation, you have the 34, the fast, or I always mix these up because this is actually a conglomeration of two. But the 34 drops below the 200. Well, that was our first clue for the bears, right? Check mark right there. And then we got the break through a critical level in the market. There's your second check mark. And then here, unfortunately, you missed out by 2 ticks on that test. That would have been right there. Right in that area right there. Probably a very, well, not probably. That would have been a great opportunity right there to try that. So maybe putting them together like you suggested there, not only just seeing the crossover, but seeing the crossover in conjunction with a break of a key level that is a typical sort of bullish bearish line in the sand. And once that break happens, now all you're doing is orienting in that direction. You would have caught if you were taking an aggressive setup, you would have caught these tests of the FMA down into the next expected support. And then from there, it's anyone's guess. Once we come into one of our roadmap levels, whether it's scaffolding, the new support and resistance I've added, one of the power levels from the day before, or VWAP, you can never expect that that's going to just continue going through it. So every time we come into one of our key roadmap levels, you have to be mentally prepared that that might be it for the move, right? So in this case, again, I don't know what ended up happening here, but it looks like we came, and then bam, there, I mean, that right there. You've got your crossover, you've got price breaking back through the VWAP, right? And now we're coming back to tag the back end of the 200 with that bearish bias. And that was the trade I think I just showed you guys. Now what I wanted to see, and actually, let's go back here. So this was actually my setup, but look at how similar that setup was over here. It almost looked identical, right? So on the first, this was earlier in the morning, we get the crossover, we're holding below PDL, we come down lower, we tag the back end of the 200. That same thing happened over here. So at the end of the day, they again tried to come back through the previous daily low, but could not hold above it. And notice, for all intents and purposes, once it got above, then it was trying to hold right around this area, right? But it couldn't, and then the next thing you know, you get that, you get the tag. That is one of those super aggressive trades I showed you guys. As we're failing from an area, getting back below the moving averages, and then getting that first tag. You had that, but again, at some point, if you were patient, waiting for the test of the 200, you got your money shot right there, right? Again, how much risk are we talking about? Probably less risk than almost any other trader takes on the ES. I mean, it's 2 freaking ticks, 3 ticks. It doesn't get better than that, and we know that these setups off the 200 happen over and over again. It doesn't mean that it works every time. You're going to get into markets like this, right, where it does kind of hold for little 1 point, 2 point, 3 point pushes, then it just chops in through it. But this type of market is maybe not necessarily what you would want to be trading anyway. Maybe the first test, right? You get your hold from the previous daily low, you get your crossover, and then you try the first test of the FMA or the 200, but in this case it didn't work. So here's a great example. It doesn't work every time, but we do know that when it works with very limited risk. So we're typically looking at, look, most of the time it doesn't work. It's just a quick swash right through it. And times when it does work, we're holding it with just a couple ticks. Right? So it's giving you levels that when they do work, typically work and hold either to the tick or within a point or two. Right? So you know what your risk is above these levels. You know that about 2.5 points above it, that's about as far as you would want to see price get in order for this hypothesis of this trade to work. Right? So we're limiting our entries to areas in the market that typically, if they hold, have very limited risk. Let me just read through some of this. So I mean, in terms of my favorite setup, again, it's going to go back to the webinar we did a couple weeks ago, where I talked about finding a setup or a test of a level that's kind of confirming for a certain direction, and we have the 3-minute showing potential divergence. And sometimes, and I don't have a perfect example right now, but sometimes you actually start to see the 3-minute signal. It's not just kind of potentially there, but it takes time. Like we might be sitting, let me see if there's one where we just sit kind of near a level for a little bit. It was actually just yesterday morning. Let's go back here. And we're sitting like this. We're right at the roadmap low, right at the 200, and it's sitting and it's sitting and it's sitting. Your 3-minute then has the time to actually get that turn, and you actually have a little peak on your RVI. So you actually see the divergence actually there, and we're still kind of testing into the level. And that's where you then actually would see a peak. But sometimes it's just kind of potentially there. Kind of like when we tested the low here this morning off the roadmap level, you just saw that there was some potential, right? You didn't actually see the curve. By the time you saw the curve, we were now way too far away to find an entry, unless you were waiting for, again, some type of pullback to a moving average or something. So that type of setup, having the 3-minute on board in the direction of the trade, is the type of trades I like to take. Let me look at some of the other questions here, and then we'll wrap things up in the next 5 to 10 minutes. So the SNR, the support and resistance, for lack of a better term for these levels, they are basically scaffolding levels. If you were to go back and you would look at these levels into previous price action, and the 3-minute might not be a high enough time frame to quickly get back here and see the larger rotations off those areas. But these are just essentially the same as how I find the eye levels or the scaffolding levels. It's just that they're typically kind of in between the larger levels. So this might be a less, I hate to say it because I actually am not going to say it because it's not necessarily true. But basically the larger scaffolding levels are typically at the tops and bottoms. If you were to zoom out and look, maybe on like a 60-minute chart of the much more major rotations in the market. And then the smaller SNR levels are kind of the smaller rotations inside of the bigger picture, if that makes sense. So they're built in the same way. They need to have continuous support and resistance off the level going into the past. It's just that they're typically somewhat closer together and kind of filling in the gap between the larger scaffolding areas. So hopefully that makes a little sense in terms of what the SNR is. How do we get the task zones? The task zones are based on the higher time frame stuff. So in this case, the original task zone from 86 to 88 here was a major task zone because it was this critical area in the chart where we came in and for almost 3 days just cannot get through it. And then the market pulled back to it and then broke out to the upside. So when the market is coming back to that previous area, it ends up becoming a very, very important. Now, this was a news event and it just swashed right through, right? But this typically becomes a very good support. And it just so happened, coming into the next day, that area, not only was it a support and resistance there, but it now became 50% of the previous day. So we have the 50% of the day, the scaffolding, and this previous major resistance that we were trying to get through, all lining up right there, right? And that's mostly why we came in and we failed basically from right in this area. And in terms of, okay, take care, Alonzo. Good seeing you. Do swings sometimes become support and resistance? No, not really. So swings are important when they're first tested. So in this case, let's see if there's anything super relevant here. I mean, like, this is a great example. We had a really good swing right here that hadn't been tested. So we even came into it and basically were bouncing right around there and then finally sold off. So when we came back to that swing, it was a relevant level, and sure enough, that was the high of the morning, or the high of the overnight session, going into the first trading day of the year. That's based off that swing right there. It doesn't mean that that swing going in the future, once we've got a test, is going to continue to be relevant. We do end up starting to build up some supply in that area, and that's probably why this then becomes relevant into the future as well. But the swing is no longer relevant after we get that first test, or after the price comes in and just kind of trades around it. It's no longer naked, right? It's no longer the first test of these swings is what I'm trading. Not, after, let's say the market did this and it traded up in here and up in here. I'm no longer concerned with that swing over there anymore. I'm only concerned once we break it and come back to it on that first time. So hopefully that kind of clears up that. Same thing over here. Like, right, what happened just within the last 24 hours or whatever. You had this naked swing. Now, the swing happened to be our roadmap level. So when we fell down into that level on Friday of last week of last year, that was the low of the day. So kind of nice that it's also not only a major naked swing here, but we also had our roadmap level right there. And then that level, because it ended up being the low of the day, also was the previous daily low, right? So it was a swing. That swing was also the low of that day, and it was also scaffolding. So that's why when we came back up into it, that became a very relevant area of potential rotation. Now that we've used it though, I'm no longer interested in it because it's a swing. We might have other things there. It might be 50% of the day before. It might be a scaffolding level. So it's relevant from that perspective, but not from the perspective that it was a previous naked swing because it was tested. Or, price came up, traded into it, whatever. And now it's no longer relevant. But 50% of the previous day is always going to be relevant, regardless of whether there's a swing back there or not. Right? So that's what where the swings kind of come from. And again, doesn't mean because we have a decent swing like that it's going to work every time. It's just that we typically do see from a lot of these major naked swings this type of thing happen, where it becomes the major rotation for the day. So now the task zones are built out looking at all these major structures that the price has trouble getting through, or from either side. It's also going to be areas where we have agreement between roadmap levels and certain price action. So it's a kind of a conglomeration of everything. It's major trouble spots in the market. It is scaffolding. So if we have a major trouble section in the market and it happens to be somewhere right around the level, well then that's now going to become a pocket. So let's say the major level happened to be, let's say there was major, like maybe right here. This is not a task zone, but just for the argument of this concept, let's say you have that right there and it's trouble, and that's not enough trouble in my opinion for it to become a major task zone, but you have a bunch of trouble in that area where it also happens to be within a point or two of a scaffolding level. And we know the scaffolding levels are very strong. We know we see rotations off of them day in, day out. And we also have the major task, the major area that we wanted to see hold. So it becomes kind of a pocket. And that's where that zone comes from. So just like we had 50% of the previous week and this major support and resistance all within 2 or 3 points, that's why it now becomes that zone, because the top end of that zone, which happens to be support and resistance, very well could be the point of the rotation, but it could be a little deeper right into that 50% area. So it becomes a 2 to 3 to 4 point pocket. So the way I draw these, and I'll probably wrap things up after this, the way I draw this is basically I do just the rectangle drawing tool, which for me is Control F12. You see, Control F12 for me. So it's a hotkey. I press Control F12, I draw it, and then if you see on my charts, these extend out like a couple days beyond the current day. And those are just basically extending the date. So let's say I draw, there's actually one on the chart, like down here, I haven't updated these yet because it's just, I didn't want to waste my time. We are not anywhere close to 4,500 right now, so I really could care less. But this is what I do. Double click, and then just go right into the date. So for all these task zones down below that have never been tested, and once again, notice, it's not just a scaffolding level, it's also those major swing highs for 2 days straight, and then on the third day, we broke out from there. And it's also the swing high of that resistance area. So altogether, somewhere right around 85 to 90, that 5 point pocket is probably going to be where we could see a rotation. So how do I extend these out? Double click, go right to the start time or end time, and usually your start time should be the later date and your end time should be the date closest to the current market date. I don't know how these get flipped sometimes, but basically because this started in November of 2023, I then want to bring this out, and actually I feel like I'm highlighting the wrong thing here. I guess not. So it started in November, right around where I highlighted. And then if I want it to go out, I just go ahead and bring this, let's bring it to 2024, down to January and to the end of January. Now that level, or that pocket, now extends all the way out to the end of January here. And then again, if I wanted to bring it out further, maybe we get all the way to February and we still haven't come down here. I'm going to extend this out to the end of February. Okay, and obviously there's not 31 days in February. So there you have it. Pretty straightforward. And that would be the same thing if I was to draw like the major swing that was drawn across here, I believe, before this we came in on Tuesday of this week. Oh, nice. So the swing here, if we didn't come up and test, let's bring this over, and I made this one of my swing levels with my template. If the market didn't test into there on Tuesday of this week, on first trading day of the year, then that level would just continue to be extended out. And unfortunately today it's literally 50% of the previous day. Let's bring this 97, almost literally. Then I would just double click and I would go down to the newer date and I just bring it out, say to February, hit OK, and now here you have it. And now I have the major swing going into the future. Drop down key. I don't know what that means. But I'll give it a second here. And the date and time box. Yeah, I mean, you could do that as well. Yeah, for however you want to do it. What I do is if I have a level that I'm looking to extend out, usually I'm just going, if we're in June or we're in January, I'm just going to move that up to 2. Now I know I'm send it all the way out to February. But yeah, very well, you can just open it up and you can actually go to the calendar if you click the drop down and find some specific date if you want it as well. Or just manually change the date, whatever works for you, doesn't matter. But that's it, guys. I think that was a good short lesson in finding trades in the direction of a bias once you get some confirmation. And then on the other side of that, not even waiting for confirmation, but trading on that short time frame and just using the moving average as your bias tool to find direction. Like I said, most people, or a lot of people, just trade based on orientation and moving averages and trade in the direction that it's giving them. And they're successful. Does it mean every time you get a crossover and every time you test the back end of one of those or one of our roadmap levels, it's guaranteed a continuation? No. Again, that's where that risk management comes in. So let's finish it off there. And we'll be back bright and early tomorrow. And I'm trying to think if there's anything to mention here before I wrap this up, and nothing is coming to mind. So enjoy, guys. I will see you bright and early tomorrow, and we'll have this recording out as soon as possible out to you. So have a great day. Take care.